Are you only taking the minimum amount out of your retirement account because the IRS says you have to? You're not alone. A study by JP Morgan found that 84% of people subject to RMDs withdrew only the minimum required. But here's the question. Is that the right strategy for you? In this video, we'll discuss RMDs, why most people only take the minimum amount required, and what are some alternative strategies that will help you keep more of what is yours in the long run. So if you want to feel informed and confident about the choices you are making with respect to your RMDs, you're going to want to make sure you watch this entire video. We got a lot to go over today, so let's jump right in. First, what is an RMD and which accounts does it affect? An RMD is the minimum amount the government requires you to withdraw each year from most tax-deferred retirement accounts once you reach a certain age. Why does this rule exist? Because the money in traditional IRAs, 401ks, 403bs, and similar accounts has never been taxed. It grew tax-deferred. RMDs are Uncle Sam's way of ensuring that you eventually will have to pay taxes on those savings. Think of it as the IRS saying, "We let you defer taxes for long enough, now we want to get our cut." Which accounts are affected? Most pre-tax retirement accounts are subject to RMDs. These are your pre-tax IRAs, 401ks, 403bs, etc. If you've reduced your tax liability when you funded your retirement account, there's a good chance that it will be subject to RMDs. There are different rules for inherited IRAs. I created another video dealing with distributions from inherited IRAs. So if you're interested in that topic, check out a link in the description below. So why do most people only take the minimum amount? There are essentially 5 reasons. Reason number 1, loss aversion. We hate seeing the balance in our accounts go down. Number 2, fear of outliving our money. It's a bit of a mental trick. If we only withdraw the minimum amount, we won't outlive our money. Number 3, thinking RMDs are a spending guideline. Number 4, we don't want to touch the principal. We want to live off the dividends and interest in retirement. And the final and likely most common, number 5, we don't want to pay more in taxes than we absolutely have to. So why is this a big mistake? Let's say you're 75 with $500,000 in your traditional IRA. Your RMD might be around $20,000. You take it, pay the tax, and leave the rest invested. 10 years later, let's say the account has grown to $800,000. Now your RMD could be closer to $50,000. That's a pretty significant increase, meaning you'll just have a much larger tax bill later on in life. So in trying to minimize your taxes today, you might be setting yourself up for a bigger tax hit down the road. RMDs are not a withdrawal strategy. RMDs are designed to help the IRS generate income tax revenue. They were not designed as retirement spending guidelines. RMDs should be incorporated into your retirement cash flow plan, but they shouldn't dictate it. If you have Social Security, taxable accounts, and Roth accounts, your withdrawal plan should coordinate all of them based on taxes, lifestyle, and longevity. Sometimes it's better to take more than your RMD earlier in retirement when your tax bracket is lower. Don't let RMDs limit your retirement. Fearing seeing our balances go down, wanting to preserve our principal, and fear of outliving our money may be reasons we don't withdraw more than our RMDs from our retirement accounts. There is a difficult truth in retirement. Many retirees were incredible savers their whole lives, but they struggle with spending the wealth that they have created. But please remember this, retirement is the reason you saved. Your early retirement years are your go-go years. Later, they become the slow-go years, and eventually they become the no-go years. So don't let RMD rules convince you to live smaller than necessary, particularly in your early years. The goal isn't to die with the biggest account balance. It's to fund a life that brings you joy, meaning, and peace. Having a plan can give you confidence to use your savings in a sustainable way. And that's the key, confidence. The goal of understanding RMDs and the surrounding strategies is to replace anxiety with assurance. When you know the rules and have a strategy, you can spend your money guilt-free, knowing you're being responsible and true to your retirement vision. Roth conversions are a reliable way to reduce RMDs, but when is the best time to do them? I did another video on the best time to do Roth conversions during one lifetime. You can find a link to that video here. If you've made it this far, thanks for watching. If you enjoyed this video, please hit like and subscribe. Thanks again for watching, and I'll see you next time.